a lot of Canadian stocks that feed into some of those areas, like resources, have struggled this year. Let's get a sense of where the Canadian stock market could end up as we move through the back half of 2023. Sadiq Adatia is the Chief Investment Officer at BMO Global Asset Management, and he joins us here in studio. It's nice to see you.
Thank you.
We were just looking, at least our TV audience, at this chart of the S&P versus the Canadian market, and I do wonder when we've got this story of Nutrien now, another headache for them. It feels like, I guess, the resources sector has not been able to catch much of a break so far this year.
Yeah, it's true, unfortunately. But I do think if we think out, more than just a few months out here, I do think Canada plays a bit of catch up with the U.S. I think things like energy should have a better second half of the year. Gold and precious metals should do the same as well. So I think as much as Canada has been behind this year, I think it has room to outperform it in the future, especially if we do continue to see an extension of higher interest rates. I do think that some of the heavyweights in the U.S. will start to pull back relative to Canada.
I want to talk a little bit about some of that sector performance, but just with this strike lingering in BC, at what point do you have to start crunching the numbers on what it means for the Canadian economy?
Yeah, it definitely means short-term pain. Anytime you have strikes or you have things like that that are causing delays in terms of their production or even how they're going to get goods out to the marketplace, I think you have to dial back your expectations in the short term. But as long as the long-term fundamentals don't change, we don't generally adjust too much of our forecast going forward. You do cautiously put things in. You might put hedges into your portfolio to protect against that short-term pain. But I still think that, broadly, Canada seems to be good. I think you have issues popping up in terms of whether it's, the situation we're seeing right now, or even every so often you get situations popping up on the political front as well, too. Those are the type of things that you want to kind of avoid and kind of think of as noise rather than long-term fundamental changes that are going on.
And I wonder about the China story, how that plays into Canada, let's say, in the second half, because coming into this year, as COVID lockdowns were ending in China, a lot of people thought that would bode well for some of our, for example, commodity sectors. And then the return, I'm trying to think of the best way to describe this. I mean, it was really more people no longer being under lockdown and going out and doing a little bit of shopping, but it didn't have the same oomph as some of the past China, stimulus stories. But today, China is kind of going back to the old school playbook of stimulus. So
yeah, and I think if you look at the first half of this year, both China or even broader emerging markets and Canada both have lagged behind. It's not surprising because I think generally people are expecting a lot more out of China, a stronger growth, kind of a quick restart. But that has not happened. I think if you think about it from what we saw in North America, we were expecting a bit of that, maybe even faster because they've seen the playbook. But I think, when you look at the consumer there, they have been slower to get back out, slower to spend. And obviously, there's still the whole thing with the real estate side there on the commercial that seems to be still holding a bit of a cloud over the markets.
So I'm looking at the TSX with a gain on the year of about 2%. Obviously, tech and a few other names have done the heavy lifting, and our cyclical sectors have really struggled. If you're feeling that there could be some outperformance for the Canadian market versus the U.S. market through the rest of 2023, what is your call on where the global economy and Canada's economy and the U.S. economy go from here? Is that a consideration in your call?
Yeah, so one, I think that the economies around the world, particularly Canada and the U.S., are holding up much better than people have been expecting, which is why the recession risks continue to get pushed out further and further, and why we're talking about higher interest rates still, going forward here. But I do think that as we think about, the second half of the year, we have to at least admit we're getting closer to a potential recession, and that does mean that maybe, we're going to likely see some of those areas come back a little bit. That includes technology, even though I would consider a lot of those technology companies as quality companies that should actually have a higher multiple. But again, if we're going to continue to push higher interest rates, that means valuations have to come down at some point. We just don't know exactly when that time frame is going to be. And so generally, I do expect the global economy still holds up relatively well. We have a short-lived recession in 2024. And then the markets continue to move forward from there.
And the valuations for Canadian equities within that landscape look pretty good.
Much cheaper, yeah. And that's why I said. So if you look at Canada versus the U.S., Canada's got a cheaper valuation. There's some more defensive sectors in there if we do have a pullback. Things that have lagged behind, energy, financials, and of course the precious metals, I think have room to go much higher going forward as well, because they've been caught up by the global situation, one with China, two with the banking sector in the US. And those things hopefully will start to, move away and give Canada a bigger lift going forward.
Okay.